Imagine holding a crisp $100 bill in your hand. This represents the sales you just made in your business. You feel rich, right? That is money in the bank. But before you celebrate, take a pair of scissors. Cut off a massive 20% chunk of that bill and let it fall. That part belongs to your suppliers for raw materials. Now, cut off another large slice from what remains. That belongs to your landlord and your employees. Finally, snip off one more piece for the taxman and the bank. Look at the tiny, jagged scrap of paper remaining in your hand. This is what you actually get to keep. If you want to stop bleeding money like this, listen close. You need to look past the top-line revenue numbers. You must understand the 3 layers of profit margins. In business, sales is vanity and profit is sanity. But cash is the only reality that matters. To visualize this, let's use a simple analogy of a coffee shop. We will track the journey of a single latte sold for $5. This $5 bill represents your revenue, but thinking it belongs to you is a huge mistake. That money has a long way to go before it hits your pocket. It has to pass through 3 distinct filters. The first layer is your gross profit margin. Think of this as your business's survival margin. To make that latte, you bought coffee beans, milk, and cups. These are your cost of goods sold COGS. Let's say those raw ingredients cost you $1. You sold it for $5, spent. Cost $1, profit $4. This 80% margin answers one critical question. Is your product actually worth selling? If this number is low, no amount of marketing can save you. You need to fix your pricing or your sourcing immediately. However, you can't make the coffee in the dark. This brings us to the second layer, operating profit margin. This layer covers the lights on costs. It pays for rent, electricity, insurance, and staff wages. Returning to our $5 latte, we had $4 left over. But now we have to pay the rent and the barista's wage. Let's assume those overheads cost $2.50 per cup, subtracting that from our actual profit, $1.50. This is a 30% operating profit margin. If this number is low, you have a management problem. It implies your overhead is too high or your workflow is inefficient. Perhaps your office is too expensive for your sales volume. Finally, we arrive at the bottom line, net profit margin. Even with $1.50 left, you still have 2 partners to pay. You must pay the government, taxes, and the bank, interest. From that $1.50, the taxman and bank might take 50 cents. This leaves you with a final $1. You sold the cup for $5, but you kept $1. This is a 20% net profit margin. This breakdown is vital because it diagnoses your health. If you have high gross margins but low net margins, your product is fine, but your debt or rent is killing you. But if your gross margin is bad from the start, you need to raise prices or lower material costs immediately. Remember, revenue feeds the ego, but profit feeds the family. Don't just look at the sales, scrutinize the margins. Don't forget subscribe.